Hey there, everybody. Welcome back to another 21st Century Renaissance and another open interest newsletter breakdown on GameStop. I'm your host, Dr. Mike LoPiano. Welcome back. Today, we are excited. We are getting ready for this announcement about the conclusion of GameStop's most recent MicroStrategy-esque convertible senior note offering. Right, yesterday and last Friday, right, we were talking about why in particular this is important and what sort of effect this is going to have on our price, especially with respect to what seems to be this 2x net asset value floor on GameStop. Something we took a look at. I sort of noticed right going into the end of last year. But which indeed seems to be respected today. So we're going to break down that a little bit more. We'll spend a little bit more time looking at that and trying to understand what happened with respect to our very recent price action here, and what I think this price up, this incoming convertible note price up is going to do in the short term. But we're also going to look at some longer term contextual factors in our broader market, as well as in some of our zoomed out charts in GameStop to try to predict and to try to think what I think is going to happen. This is basically the takeaway, right? You want a little morsel to walk away with right at the start. I think we are entering into another sort of macro periodization within this recent GameStop trend, right? So we'll break down that in this video and why I think this is going to happen. Okay, so first up today, before we hop into it today, once again, enjoying a cup of coffee from oh, there we go, there it is. Trust the journey. It says there. You can see I enjoyed it very much. That's the enjoyment mark. Trust the journey. Yeah, good motivation today, but certainly enjoying it from Fervent Coffee. Keith and Tabitha sent this over my way. Very delicious. Notes of blueberry from Ethiopia, one of the oldest Christian countries in the world. That's a fun thing. Did you know about that? Anyway, thank you very much, guys. Definitely give it a try. Link to Fervent Coffee is going to be down in the description of this video, along with the link to today's article and video you're at the video breakdown along with today's article as well. Let's see, today's newsletter, pretty sure brought to you once again by Kurt Lusko. Short Fridays, yes, Kurt Lusko. Both today's article and video brought to you by Kurt Lusko, aka Short Fridays, as well as our monthly supporters, Dat Screfto, Ken Wedmerlin, and Not Medical Advice, who help offset some of my data expenses on a regular basis. Thank you very much, and thank you to everyone who has contributed and continues to support the channel. We are we're going, man. We're going. It's 10 months and counting since I started this whole journey back on Reddit. So yeah, that trust the journey, right? Never thought I'd be here, and never thought necessarily we'd be here on GameStop, right? So that's a journey that goes back way far back, right? Back to back to 2020 land on this side of it. So yeah, so let's hop right into it. Why do I think? Let's start with this question here before we get into our usual breakdown stuff. What am I thinking about here in terms of why we're going into something of a macro cycle? So right, if we take a look at, all right, well, needless to say, GameStop is highly cyclical, right? A lot of stocks are, but GameStop is highly cyclical. And there are a number of factors that go into determining these cycles. So we have sort of, we have cycles within cycles. So it's something like, if you were to stack it up, we've got something like ETF cycles. And then if you package these are a bit shorter, right? ETF kind of margin call cycles. These sort of fit within the span of about 4 to 5 weeks. So you can pack maybe about 2 to 3 of them within a kind of larger cycle. And sort of each cycle has 2 sort of split phases, right? So over the course of that phase, maybe you'll get anywhere from 4 to 6 ETF cycles, depending on how long it is. So let's take our most recent one. And I've used the term in the article today, demi-lune, half-moon. Right? They're going to have this demi-lune structure to them just here, right here as well. This kind of has, a flag, a wedge, or, something like that. But, right, if you look at you can sort of trace this sort of demi-lune move. Same here, right? Okay, this one's a lot tighter, but it's in there. Okay, so they're going to have an up phase, they're going to have a down phase, and then within each leg of that phase, we're going to have ETF cycles that'll determine some volatility within here. Okay, now what is determining these sort of bigger phases, right? Because it's not just, okay, we're in this cycle, we're in that, right? It's layered cycles here. So what seems to be the case is that the broader cycles, the wider cycles here, are determined by swaps. There is some swap expiry stuff that kind of punctuates these sort of the half cycles, or kind of the up phase, the down phase, right? So up phase, down phase, up phase, down phase, up phase, down phase, right? Okay, so basically, and then of course all of this is, if we bump over into the whole weekly chart and look at what GameStop's looked like over the past several years, GameStop has been in a, let's call it a macro up phase since early 2024, and that was a major turnaround for the stock, right? So up phase, major macro up phase in 2020 and 2021, and then down phase starting in November of 2021, basically all the way up until, you could point it out until, April here. This kind of Oklahoma, and we call these like little Oklahomas, these little cauldrons here. It probably, right, so the down phase probably technically ended, this sort of big down phase, multi-year down phase, likely did end with quarter 4 of 2020. Well, right, so the quarter 3 earnings report, quarter 4 of 2023. And this was a big push down to basically get ideal positioning to prep for what we're looking at here. It could have continued. There were likely institutions that wanted this to continue. A lot of people, right? So we talked about yesterday, we talked about net asset value. We talked about how GameStop has largely been valued at 2x cash, 2x net notional asset value, I should say, which assesses the value of the business at something like, at least zero, at most zero, and at worst negative. So depending on how you're making that calculation, GameStop's true floor going back to 2020, end of 2023. Okay, I would say end of 2023, it's probably looking like, zero, right? So overall on the year, the company did turn a very, very slight profit. So zero, right? And that's basically Wall Street's opinion. This is regardless of how long this retail can survive, it's not really, what is it worth? Maybe it's worth the brand, something like that. But at least zero. And two other Wall Street folks, there's also the disguised value of the fact that GameStop is very highly volatile, and volatility itself is a product that can be sold to other institutions, right? To hedge funds, to investors, to smart money. Let's say volatility is a very, very valuable product. So for the purposes of more advanced trading and the like, we won't get into that as much today. We can talk about that more at this week's live stream. So right, these structures that we see emerge, and okay, the sort of the extra stuff here on our 2024, this sort of May-June return, right? So if we kind of shave off this, like, right, you can see we kind of go up just shy of 35 here. If we're going by kind of closing, rather than, whatever was going on intraday or pre-market here, right, we can attribute this sort of excess over the top going up to 80 and whatnot as potentially related, likely related to whatever Roaring Kitty was doing, and sort of algorithmic reactions to that, and sort of swaps related all the way back to 2021. That's probably why we jumped up there. And sort of this was issue maybe with how algorithms were reacting to these swap rolls and what was going on, right? It's no coincidence that we saw these crazy prices in after hours or pre-market. But if we go by closing price, right, that tells more of the story of sort of where we were averaging in here. So you can see that a bit more clearly. It looks very similar to what we just did in November and December, and then into this early part here, right? So, but how did this differ? Well, what actually differs in these different phases of the cycle when we do come down is how low we go based on the price to book value ratio. So, or what seems to be about 2x the notional asset value. So the last time we had a dip of this kind, I would say what we saw in our price action yesterday was back in August, actually August 5th. This was the last time that we actually got something that dipped below that ratio. We don't really have any pricing at all, basically until for a fraction of the like 30 minutes yesterday, right? But that's what we saw on August 5th too. The last time that there was an attempt to test lower, it basically within an hour got bought back up above that ratio, right? So this one single day did not last basically beyond just the hour of our opening. As soon as it could be bought up, it was bought up back to at least that ratio, and then we moved back up a little bit, and then right when we came back down the second time, then we went back to our cash floor here, right? So this 2x here, right? And so we respected that until we got some more cash, and then this time we came down higher floor, right? Okay, so something like right back here, back here, this was still actually way above 2x cash. This was 2x cash. This was 2x cash. And then here, right, 2x cash with this yesterday, this slight dip into the upper 20-ish, right? What was our low? Was like 2080 something. I think something like that, right? What was yesterday's low? 2080 something. 2073. Yeah, so that's below that ratio, but I mean that lasted all of 5 minutes that we were below 2x cash. Yeah, I think. And then we came back down one more time, and that lasted maybe, we spent again maybe another like 10 minutes below that ratio. And then as soon as that was done, we just rocketed back on up over a course of about an hour. Yeah, like way back above that. So hey, great finding there, right? That it held, right? That held up, right? I mean, yesterday making the video, seeing that happen, I'm like, oh, am I about to look like the biggest freaking doofus on the internet right now? Like talking about this, like, oh, this is it. And like, I'm talking to Richard about this, and we spent like several hours like, oh man, like he's going back in this spreadsheets and like looking at this ratio back in 2020. We're like, oh my gosh, did this guy Ryan Cohen's buying, blah, blah. And then to be making the video like while I'm trying to talk to you guys and present this, then just in the background, it's just like, oh, all right, we're going to 2073. Like enjoy looking stupid. But in any case, it worked out, right? So I guess not as dumb as I look. So that worked out. But okay, so what's going on here? What's a strong signal that says, why do I think we're going to get this kind of blue squiggly here? Why do I think we're going back? Now we're moving into an up leg of another demi-lune. Okay, number one, we just hit that cash floor and it held. So that happened, right? Every time that's occurred, that doesn't last, right? More than like, in August, it didn't even last a day. And then we moved up into like 23-ish land, and then went back into like 20-ish land, and then back to 25, right? So that didn't last. 19-week, let's see, the time we tested the cash floor here back, let's see, back in September following that 20th dip there, or prior to the 20th, right? So we got that big move up on the 20th, likely related to Chewy fails. The one thing I have to actually check out, I have to spend some time. I know some people have talked about this. Probably one of what Roaring Kitty was suggesting with all this Chewy stuff is that if you want to understand GameStop swaps, you actually have to read Chewy swaps. That for some reason, these like Chewy swaps, or swaps that are labeled under Chewy, are having this very interesting effect on GameStop's price. So there's a bit of an inversion there. Now they do line up. So like the 28th and the 31st, there were Chewy swaps and there were GameStop swaps happening at the same time, expiring at the same time. But something to look into in terms of, there's a huge amount of notional value in Chewy swaps that's expiring on the 14th, but there is not on GameStop. So if that relationship holds up, we might get something. Well, we might get something like what we saw here back on September 20th. Well, that was Chewy fails. We might get something in here, but that would make sense, right? That would be something. There were a lot of Chewy swaps in this November run, not GameStop swaps though. So if this holds up, we might see that type of relationship emerge once again, right? Chewy swaps are expiring. GameStop starts moving up as a result. Whereas where GameStop has no swaps, Chewy just kind of hangs out or something like that. But I don't want to speculate too much. Anyway, what do I have at this chart? Why is this chart marked up the way it is? One thing that seems to be an indicator of the cycle shift is a particular set of criteria. Again, Richard and I went through this back in early February. We were talking about this. So a lot of my observations too, or the way that we refine these criteria were to kind of go back and look at different stocks and sort of look at the frames of reference where this tends to work based off of Roaring Kitty's hints. So why did we start looking at this? Why did we build this out in TradingView? Roaring Kitty has this, right? This is all the way on Roaring Kittinger's charts. So if we go, we can see this. Actually, if you want to look at what it looks like for him. So Roaring Kitty's got this down here. This is his, his momentum chart. So he's got daily. It's zoomed in pretty close, but it's down. Yeah, it's down here. Okay, so you can see it's very, very, very similar here. Okay, and Roaring Kitty has essentially he has his setup. So he's got a signal line. This he added, right? So if you just put the PMO out there, it doesn't have the 55 signal line. Roaring Kitty uses the signal line, this 55 moving average superimposed on the price momentum oscillator as a signal line, so that when the two PMO lines cross this line, cross the 55 signal line, that can be a bullish or a bearish signal. So the most powerful signals, it seems to be in this chart, based on what Richard and I looked at, was the when you have all three cluster a decent ways away from the zero line. So you have this dotted line here is the zero line. When you have all three cluster toward the top, they're well above the zero line, or cluster together at the bottom, you're looking at a big move imminently about to happen once things start moving in the other direction. So for example, I pointed this out to you guys earlier when we were looking back in February. We were looking at SPY. That's primarily where we tested this out at first to try and understand this. Was looking at, all right, let's go to the weekly chart. Can we understand this? Does this just work for GameStop? How does this actually work? And sure enough, it predicted that very large down move. In fact, it predicted it by several weeks looking at this weekly chart. So the big SPY down move from all-time highs down to 550 looks like it was predicted. And okay, is this going to hold up? We're going to see over the next couple of months whether this is going to play out. This is going to look like 2022. We will see. So, okay, so we look at this clustering. And as you can see here, right, so back early January, what did we have? Yeah, right when we got this big move, basically the degree to which we got this move said, I will wait for you, right? So that's essentially, we had two things sort of surface around that time. December 20th, we had this March 26th tweet, what I consider to be a March 26th tweet from Ryan Cohen with this advertisement. So TA team, okay, it's talent acquisition, but he doesn't post all the talent acquisition stuff to Twitter. He only posts things that seem to have to do with TA, right, technical analysis. So I pointed this out back on December 30th. Had plenty of Reddit ne'er-do-wells, maybe even fake people mock me for this. So I guess I was on the right path, suggesting, right, based on this tweet, that we weren't going to see some bigger move in the stock, that we were going to have to wait for something big from the company until March 26th. And sure enough, March 26th was a heck of a bullish day, but March 26th was when we were going to see something like some movement back in the other direction from the stock. But of course, then what I thought as well with Roaring Kitty's tweet, a lot of people, right, there were some ideas. We needed to test some stuff out. Maybe it had something to do with Unity. Maybe it did also have something to do with Unity. I'm not sure. But what seemed to be the case around the 22nd, right, the 22nd was a day or two after we got these uncrossed on the daily here. And so what this basically said was, it's over, right? This up phase, right? This up phase of this cycle, moments passed, something's not coming from the company. It looked like Roaring Kitty was saying, all right, Ryan Cohen, I'm going to wait for you, or something like that. And so sure enough, here we are positioned after the 26th, where the 26th or slightly before, right, we started moving back up. Not quite there, but now we're getting really close to a cross. So let's bump back over to my chart here, right? What we can see is in GameStop, this also holds up. So if we go to the daily on GameStop, we go to the daily chart. We also have some weekly PMO stuff. Not going to talk about that today. But if we look back, we can see that these crosses signaled some very decently sized moves in GameStop and the beginning of this sort of up leg of this demi-lune. So what it looks like GameStop is doing, we get these big moves, it starts to go up. What I expect, right? I think potentially Roaring Kitty is using the co-occurrence of maybe these momentum cycles with his reading of something like swaps and ETF data in order to figure out the absolute ideal entry times for larger up moves. And of course, he added a little salt and pepper to it back in May and June of last year. But right, so we had one toward the end of 2023, which culminated in January of 2024. Obviously, May, June, we had this other up move. And at the beginning of these was indeed that cross. Okay, so the cross occurred in May, June, this pretty big candle, but man, if you got in on that, right, you got in here when it kind of hung out above the 200-day simple moving average, like, all right, you were looking pretty. The next time we got this, okay, we got the uncross here. Very interesting, very interesting. Despite the fact that we got this, the continuation of this move into July, all the way up to 30 again, 29.99, we got the uncross. And that resulted in this huge down move back below even our cash floor there. Okay. And then up we go, up we go, up we go. But we don't, right, move up until, man, wouldn't you know it, it's National Cat Day. And so up we go, up we go, up we go. Get the uncrossed, down, 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 down. And where do we find ourselves here? Little hint from Ryan Cohen's TA team, March 26th, we start moving back up here. This move, right, this heavy shorting from the arbitrage prevented that type of move from happening, say, the end of last week, because we might have uncrossed there. But once we get that cross, survey says we're going back north. And it's not going to be a small move north. On the daily chart, these are not small moves, okay? What is additionally, right, what's additionally very interesting is you say, okay, well, we're going to move up, we're going to do this. What about when we come down? How far do you know when we're going to come down? Because I'll tell you, right, I wasn't necessarily looking, right? I didn't have something to gauge. I had noticed this in our sort of the September, October phase. I noticed that we weren't moving below this 2x cash floor. I noticed this actually way back last summer. I was like, wow, we're kind of backstopped, at least there. Like, we can't really move below that. That doesn't make sense. So, right, that's how, when I was continuing to build out my trade and start doing my, like my short options and volatility trades all throughout here in order to build my position into this big move. That's what I was looking at, and that's what I was basing off that. I was basing off that, right? Basing my position building off of that idea. But then coming back down here, I was like, man, well, how far are we going to go down? Did something actually change here? Nothing changed with the company, but like, man, we really moved up. What really was that? And what seems to be the case is that even through these up moves, the gauge for how far we move down is going to be this notional asset value mark. So we'll have an up move. We'll get more offerings, right? We kind of have the pattern now. We'll get different kinds of offerings, convertible bond arbitrage. Traders will come in and do their thing when we do those. Legacy shorts are going to have a hard time with their positions, and maybe Ryan Cohen is going to do things like more at the market offerings to get them an out in exchange for billions of dollars for the company. And so on the other side of that, when we get these, we're going to be able to gauge what our new minimum will be, what our new floors will be in successive cycles. The following cycle, because we'll shoot up through it, and then on the other side come back down to it prior to there being this next offering, seems to be the case. That floor, that new notional asset value is going to act as the floor on the other side, plus whatever new money the company is actually able to get. Now, what does that mean with respect to Bitcoin? Because the Bitcoin bit is going to be a little different. So Bitcoin, of course, is a volatile asset. Now, that's going to be popular with arbitrage traders. That's going to be popular with these sort of gamma convexity traders. Anybody who is being sold these bonds because of GameStop's underlying volatility is going to love that, because that says, hey, Wall Street, we know you guys love to trade vol. Here's even more because we're going to go buy Bitcoin. And Wall Street goes, oh my gosh, not only do we have this amazing investor base that, will do ridiculous things with options that we can just suck premium out of, but now you're bringing even more crazy guys from Bitcoin and crypto and all of this. Interesting. We're in. Give us the bonds. We're super down. Okay. That seems to be the case there. Now, what would be interesting with respect to Ryan Cohen? Okay, why would he do that? Does he want to screw his own investors? That doesn't make sense. Knowing that Wall Street is going to leech off of us or something like that. That doesn't seem awesome. No, but here's the thing about Bitcoin, right? By specifically targeting Bitcoin, okay, maybe it does introduce some extra volatility that brings, the raptors out to feed. It does also change the way that GameStop is going to interact with ETFs. And so GameStop is now going to shift, just like MicroStrategy did, from being in this kind of narrow category of company, right? So GameStop was in things like small cap and then eventually mid cap. I think now it's in some mid cap ETFs and retail, and that's kind of it, right? That's how it's been classified. Ryan Cohen has made a point with this last earnings report to say that GameStop, although it has a retail business and does not plan to get rid of that retail business, that retail business is secondary to GameStop's identity. That GameStop is foremost going to be a company whose strategy for increasing and optimizing shareholder returns is going to be investment. So by declaring for Bitcoin, now GameStop's going to start to be added to Bitcoin ETFs. It's going to be added to crypto ETFs. It's going to be added, to tech ETFs or something like that, right? Even though, what are they doing? They're just going and acquiring a large amount of Bitcoin, supposedly. Well, what does that do? Well, okay, if you're creating more institutional demand for GameStop, you're creating more institutional demand for GameStop. So, okay, you're selling volatility to volatility traders, to arbitragers. Okay, that's number one. You're creating that institutional volatility. Supposedly, there's institutional demand. Supposedly, there's already massive demand for the convertible notes, 5 times. Right? So apparently, the order book was 5 times oversold. I don't know what that means. I don't know how you oversell it by 5x. But anyway, there's huge demand apparently for these bonds. That's number one. Number two, if you put demands over in ETFs, new ETFs, then those ETFs are going to want to acquire shares of GameStop in order to increase their holdings. So, right, GameStop's been bounced around between a certain number of ETFs. And of course, when GameStop goes up, okay, then these ETFs will have inflows, and when it goes down, it goes down. But that's usually all been, as we've seen, that's been tied to the fate of the market. If the market is going down, GameStop's going to be adversely affected. If GameStop is now tied to Bitcoin, okay, yes, you're introducing this new source of volatility. It's going to be maybe harder to judge that net asset, that notional asset value, and how that's going to relate to our floor. But it also means potential volatility to the upside, and it also means a hedge against equities, right? It's as it's been stated, a treasury reserve asset. So now, okay, you're looking at ETF outflows during market downturns, which we are in the midst of, and what it looks like, we'll point this out in a second, it looks like we're going to be seeing. But now Bitcoin acts as a hedge against that for GameStop. Very interesting. And it's going to be picked up, right? Shares of GameStop, there will be buying pressure and buying demand from new categories of ETFs in the meantime. So, okay, so even though, yes, that introduces some volatility, on this side of things, is that going to result in a much higher floor than just this cash, notional asset value times 2, right? Maybe it's going to remain notional asset value times 2, but what happens when, there's a huge amount of buying demand on top of that? So, personally, I love the idea of it just staying in cash because it's just easier for me. I don't have to keep it running all right, what's our actual floor here? Which is a little bit more difficult to figure out when you've got Bitcoin there. But, maybe in the short term or maybe in the immediate term on this upcycle, it results in a way higher floor on these things, right? Very interesting to consider. So, so PMO looks like we're moving up there, right? Looks like we're about to begin another one of these phases. And, right, so this time when we come down, this is the thing. I drew this just like this, but, it may we may shoot up to 40 and then only come down to 25, right? Something like that. Or if we acquire Bitcoin in here, we shoot up to 40 or 45 and then only come down to 29 or something like that, right? The sticker price on those bonds during this upcycle, right? It may look more like this upcycle that we saw last May, June, where we really start cranking up. We go, whoa, 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 whoa. We have all this cheddar on top of everything, a little paprika, little salt and vinegar. And then we come down. And then this time when we come down, we don't really go below, okay, we try out 1750 pre-market. We try out 1850 off the open, but can't stay below 1950, this 2x cash value. Maybe we do something like that. And then, we'll try out 24, we'll try out 25. But then we can't stick below that when we actually come down after the next cycle of offerings. So, of course, obviously, there's some more swap stuff to kind of, sprinkle in there. But it does look like we're setting up for something like that. And once we get this move, right, it looks like it's coming. And it could be the fact that we're looking at this announcement on the completion of the bond offering. That seems to be the type of catalyst that's going to trigger us there with our with our daily PMO. So, and why is this good? Well, this whole Bitcoin thing I'm talking about, well, SPY's not looking awesome. And as we've seen, right, we traded pretty similarly down with SPY, even to have, mirror days of trading down, assumably based on ETF outflows. So that could be done, or done to a certain extent, right? That may be no longer, the sole kind of determinant on GameStop's price action during these down moves. So ETF outflows might not affect us in the same way, right? If equities are moving down, all right, but Bitcoin's moving up, the algorithms are not going to be, okay, we get some outflows in some ETFs, but we get inflows in some others, especially because we have this interesting feature where equities that hold Bitcoin as a treasury reserve asset appreciate at higher multiples than Bitcoin itself. So that's the case with MicroStrategy. Over the past 5 years, since MicroStrategy began acquiring Bitcoin, they have appreciated at 5 times the rate that Bitcoin has, even though their whole thing is Bitcoin yields. So something very interesting going on there. If we look at SPY, right, it still looks like we are in the midst. We're looking like we're doing what we're doing in 2020. We did move below the 50-week moving average. So the average price essentially over the last year, we did move below that. We got a brief move back up there, right? Brief little whoopsie-doop in March. Maybe we get another, kind of move up here if we go down, we test the 100, something like that. But yeah, really looks like, those are not curling anytime soon, man. Those are not coming back up on the PMO here. So looks like more downside. Looks like Yeah, at least more downside until we get to that 200-week moving average. And then that will be a very strong technical catalyst, but it'll be a question as to whether that's enough to get the reversal in the PMO here. It was in 2023. It was in 2020 during the COVID dip. So we'll see if that holds up heading into later this year. But we'll get these kind of hitchback things, but it's not gonna be all sunshine and roses for the rest of the year here. Yeah. So if we look at our GEX on SPY, yeah, as long as in the short term, probably staying above this 550 level. If we do see a break of that 550 level, then yeah, we're going to start moving down pretty hard, which we might do into April OPEX because it's not optimistic, right? We can see this. April OPEX, not optimistic, and going into late April, early May in terms of the broader market, not everybody's ready for it to go down. Let's say that's continuing to be the case. So BOJ meeting April 30th may inform that a bit more. We'll see. Keep you posted on that. Yeah, and then short-term stuff. We got that early move down yesterday, tested that floor, but then could not really go far. Couldn't really stay down there for more than a few minutes, and then up we go. Probably starting our price up back again, which we are. Do we have an opening price? Okay, yeah, they're moving us down a little bit. Yeah, a little move right off the open. Yeah, we'll see. Probably not getting that hard price up until we do get the announcement. So expect a little play there. We do have some shares available to borrow. Right, they're doing wild things here. Let's see what they're looking like right now that we've opened. Back down to 1,500. So yeah, they're probably hurting. I know Richard's been talking a lot about what's going on with the ETFs. He is our ETF master. And yeah, there's all these FTDs, right? XRT's been on Reg Show, been on the threshold security list like weeks prior to earnings. So they got to deal with that. They got to deal with, we saw all those fails on IWM back in February. They got stuff to deal with. Okay, so those are likely two other sources coming in that are complicating things. There's huge demand. Now, here's the other thing. Here's why the convertible bonds, actually, this shorting that we saw take place last week, this is why this actually helps our situation. Okay. Huge demand for short liquidity on the part of these arbitrageurs. Okay, so the first thing you do, you're going to go long the bond, you're going to short it. You're going to short the underlying stock so that you can profit off of the gamma exposure. That's what the arbitrageurs do. Huge demand for GameStop short liquidity. That is likely why we see the cost to borrow going up as much as it has recently, and maybe why we have all this restricted liquidity. We went from having more liquidity in GameStop than anyone could hope for to now we're getting back down to, this is kind of mid-November, like late, or I should say early December levels. We bumped down to 950,000. We have not seen liquidity that low since prior to our January 14th fall off there, 13th, 14th fall off. So, we've seen that short volume's gone up, utilization is going up. So there's now competition for access to that short liquidity on the part of these bond arbitrageurs. That's not good if you're a legacy short. You're like that supply is tight enough as it is. Look at all the juggling that they've had to do between ETFs in order to keep the lid on this thing, in order to keep their strategy working, so that their swaps don't go belly up and then blow them up with it. This is now, we just went from more short liquidity than we've seen ever to liquidity crunch. This is liquidity crunch. This is short liquidity crunch levels. It's not quite like it was, like it got real close on like January 6th or 7th, I want to say. Just before the market holiday on the 9th, right? The National Day of Mourning for Carter. We got down, I think, to 50,000 shares available to borrow at one point. So it was like what was there was being used to cover FTDs. We're getting back down there. And if that's the case, then these swaps might not be looking good for who's ever holding them. Okay, whoever was there last week, right, the 28th, or whoever was there yesterday, maybe they got out, but there are a lot more swaps, like years out. Like I'm talking, there are swaps that are decades out, at least 10 years out, 9 years out. And there are some swaps that have no expiry. Their expiry year is the year 9,999. They're just perma swaps that were likely opened until the company went bankrupt. Or it negotiated for the swaps to be closed, right? They don't have a maturity date. They're just forever. Very interesting to see that dynamic at play there. And that also might, could easily have an influence on our movement into this upcycle. So, that looked to have been an important component in what we saw in December. So not the November cycle. That was not based on restricted short liquidity, but the December cycle looks to have been related to restricted short liquidity, right? That's when we saw XRT toward the end of December go back on the Reg Show threshold securities list. So this is also a good signal, right? Seeing this. Very interesting to see that pop up there. Okay, so what are we looking at today? Well, need to be aware of possibly some of this being used, but our options landscape is reconfiguring itself in some interesting ways. We do have max pain at 23, but what does our GEX data tell us? Well, we do have this nice little ramp set up here between 23 and 24.50. So we remember we had a fair number of these back in the fall. We had a fair number of these going into what was happening in December and November. So why do I say gamma ramp? Well, normally, right, net call GEX strikes, assuming that they are net trader long, which generally is a good assumption in GameStop. Again, I can't say for certain. This chart does help us try to remove some of the noise, so we're not going through, every strike and figuring out what the sentiment of every trade was. And it can be hard, and it's difficult here, especially because now GameStop options activity is very, very high, and there's a lot of volume at strikes that previous to this, it was not common to see that type of volume. So it can be a little difficult, but this can help us eliminate some of the noise. And we can assume, again, take this with a grain of salt, we can assume that when we see net call gamma, that traders are net long and that dealers are net short that gamma. Okay, so what does that mean? I should say it is dealer negative gamma and trader positive gamma. Okay, so with that gamma on the dealers' books being negative, as the price goes up, they're going to buy shares to hedge that negative gamma. So options dealers are trying to remain gamma and delta neutral, whereas gamma traders want to be exposed to gamma. So they're going to buy shares as these strikes go into the money. Okay, so they're already delta hedge, meaning they have a certain number of shares already that they're holding on to, and they gamma hedge in order to dynamically account for volatility in the rate of change of delta. That's what gamma is. Gamma is a derivative that measures the rate of change of delta, and delta is the change of the price in an options contract with respect to a dollar move in the underlying. So what happens when the price starts to move up? Okay, well, normally if you have an isolated strike, so we talk about call wall properties. You guys always hear me talking about the call wall. I use the call wall very frequently to target my short options trades because it is a very, very high probability that the market maker is hedged in such a way and will approach the stock in such a way that this strike on any given expiry is going to remain out of the money. Now that's not always the case. There are, maybe about 10% of the time in SPY, it's close to 10% of the time in SPY, you do see call wall breaches. But in terms of GameStop, it stays out of the money a really high amount of the time. And what you'll see too is when you'll have a call wall breach, you'll see something like you'll have a midweek call wall breach, but somehow at the end of the week, it will still close under the call wall. So all of those contracts will be out of the money. However, all of that previous volume right in the middle of the week that took it up through the call wall will cause further buying for further out expiries such that the call wall will move up. And then the subsequent week, you find yourself trading in a new bracket. Okay, so dealers are very often operating to keep the call wall out of the money. Now, they have certain properties. They end up also, due to intraday options positions, gamma hedging tends to make those levels, especially in terms of net call gex, so net trader long gex, net dealer short gex, to keep that strike out of the money, right? So it's resistant. Gamma hedging, so gamma values, when you look at a gamma value curve, gamma is going to spike when a contract is going to right about to go in the money, right about to go out of the money. So as soon as it goes out of the money, gamma starts to go down, and so the dealer doesn't have to be is shedding shares or is not buying as many shares as it goes up. So it can be a selling dynamic, or it can be just not buying as many shares, right? So there's less delta to have to hedge, and so the rate of change of delta is going to go down because delta only goes up to 1. So if delta is 0.6, then there's only so much delta that needs to be accounted for, or possibly accounted for in terms of that options position. So typically when the call wall is approached, right, it's the largest one. So you have gamma will go up as it's approached, and then as soon as you hit it, then it slows, and so you'll have a good rate of approach as the market maker is the dealer is hedging that position, hedging that gamma, the gamma of that position, and then the gamma hedging will peter out, and hedging will be weaker on the other side of that. So what is a gamma ramp? Well, a gamma ramp occurs when that effect is offset by the fact that right on the other side of a given strike, of a given call gex dominant strike, that you have a larger net call gex dominant strike, so that the gamma hedging of the strike immediately above the one that's about to go into the money has its peak in gamma value when the other one is about to go down. And so because it's a larger open interest strike, there is absolute value, more shares being gamma hedged by the strike that's about to go into the money than by the one that's sort of has already gone into the money. And so if you layer a bigger strike, a bigger strike, a bigger strike, a bigger strike, as you move up, that larger strike is going to overpower the slowdown effect of the strike immediately to its downside, and you'll get a whoop, 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 and it'll essentially, as you start going up, suck you up into the nearest area of resistance, which today we do have this little guy here, right? From 22, basically all the way up to 24, we have a gamma, and some 25 is going to play into that a little bit, but in a static landscape, we'd probably get stuck somewhere around here. So that momentum would run out somewhere, it'd be higher than 2450. We probably would move straight up into that 25, and then we'd get some reversal trades intraday from options traders. If, however, and I pointed this out, right? So see how it peters out here above 25. If we get a large amount of new positions, if traders come in and they reposition themselves or build new long call positions above 25, net trader positive gamma, net dealer negative gamma, then this could potentially continue. And yeah, we could see, I would expect that we're going to need the announcement to actually function as the catalyst to actually, get us up here. But if we do, I think that then that's going to end up placing us in this 25 to 30 bracket here. And then, we'll be in position to kind of over time run up that. So we'd start looking something like November. Although I will say we will have to start looking out for, we do have to look at these 414 Chewy swaps. I have to do that, try to understand how that's going to work. Richard's on that. Richard's on the ETF game, trying to figure out what's going on there in terms of, when we should expect some of that potential volume to come through. We don't know if the company's going to go ahead and buy Bitcoin. If they say they're going to buy Bitcoin, is that going to be another catalyst? How many things are we going to have kind of layering on top of one another? That's an open question. But things do look good, man. Like we look pretty well positioned to start going somewhere in GameStop. And we have enough catalysts that are enough factors, a sufficient number of factors of a source that is detached from, let's say, whatever's going on with the equities market. with these sort of SPY bearishness or something like that is what I intend to say. So that is looking up. That is very interesting. Obviously, going to keep monitoring that. Going to keep looking at that going forward. But yeah, and IV obviously, right. Enough to say that IV will go up if we do any of that. IV will start to move up as well. So a lot of things to look out for. To sum up, right? Things are looking. All of that is looking really good, right? Promised I'd do a little sum up here. So all of that's looking really good. We have great stuff looking at, PMO. Very interesting what's going to happen with the acquisition of Bitcoin and how that's going to maybe detach not only how our net asset value changes with respect to the broader market, but whether the broader market is going to, will bearishness affect us in the same way that it has in the broader market going forward? There has been a strong correlation, but with Bitcoin, that kind of acts as not only a hedge itself against market volatility, downside volatility, I should say, but it can then recruit new ETFs to send basically to it can stimulate inflows with new ETFs that will acquire GameStop in such a wise as occurred with respect to MicroStrategy, which is very interesting. And of course, all of this combines to these new arbitrage strategies with respect to the bond put a strain on available short liquidity, which is going to put the squeeze on whoever is still short GameStop, back way back with respect to these legacy positions with respect to swaps and the like. So a lot of really interesting things to look forward to. The precision is going to be tough, but on the whole, things are looking really, really good. And I think we are moving into one of these, the up leg of a bull cycle here that's going to look something like what we saw in November, maybe April to May of last year. Can't guarantee we get, like I said, can't guarantee we get a little barbecue sauce on it, like Roaring Kitty brought, Little Frank's Red Hot. But to have that kind of closing price archetype, I think that's highly likely, and we're moving into that phase at this point. So thank you very much, as always, for watching and listening. I look forward to seeing you guys next time, and look forward to, hey, that announcement. So take care, and thanks, everyone.